Are you worried about missing out on the best investing advice? Hey everyone, welcome back to the CRAIGTRADER podcast, the podcast where we explain investing in a way that's easy to understand. I'm Alex. I've been investing for about 10 years now.
And I'm Jamie. Whether you're a beginner or an experienced investor, today's episode is all about the important stock market words every investor should know.
That's right. We're talking about terms like dollar cost averaging, diversification, indexes, ticker symbols, and more. So let's get started. And don't forget to like, subscribe, hit the notification button, and share this video. Also, check the links in the description.
All right, let's start with the basics. When you look up a stock, you'll see a short abbreviation next to its name, like AAPL for Apple or TSLA for Tesla. That's called a ticker symbol.
Yeah, think of it like a stock's nickname. It's how stocks are listed on exchanges like the NYSE or NASDAQ. Every company has its own unique ticker, so when you're buying or researching, make sure you're looking at the right one.
Next up, dollar cost averaging, or DCA. This strategy is great for lowering risk. Instead of putting all your money into a stock at once, you invest a set amount regularly, like every week or month, no matter the price.
Yeah, this way you buy more shares when prices are low and fewer when prices are high. It evens out market ups and downs and helps avoid the stress of trying to guess the best time to buy or sell.
It's perfect for long-term investors, especially in markets that go up and down a lot.
Now let's talk about diversification, one of the golden rules of investing. It simply means not putting all your eggs in one basket. Instead of buying just one stock, you spread your money across different assets.
Exactly. Diversifying can mean investing in different sectors like tech, healthcare, and energy, different asset classes, stocks, bonds, real estate, or even different geographies, US, Europe, emerging markets.
This helps manage risk because if one stock or sector goes down, you're not losing everything.
Okay, so you've probably heard people say the market is up or the market is down. What they're usually talking about are indexes.
Yep. An index is a group of stocks that shows a part of the market. Three of the most famous ones are S&P 500. It follows 500 of the biggest US companies. Dow Jones, DJIA, it follows 30 large, well-established companies. NASDAQ, it focuses on technology companies.
Putting your money in an index fund that follows one of these is an easy way to invest in a big part of the market. Next, let's talk about market capitalization or market cap. This is just a fancy way of saying how much a company is worth.
It's calculated by multiplying a company's stock price by the number of shares available. Large cap stocks with a market cap over $10 billion include companies like Apple or Microsoft. Mid-cap stocks with a market cap between $2 billion and $10 billion include companies like Etsy or Roku. Small cap stocks, those under $2 billion, are riskier but have high growth potential.
Knowing market cap helps you understand the size and risk of a company before investing. Okay, here's one a lot of investors love: dividends. Some companies pay their shareholders a part of their profits, usually every 3 months.
Yeah, if you own a dividend stock, you're basically getting paid just for having it. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble are known for paying dividends regularly.
Some investors even build dividend portfolios to create streams of passive income.
You've probably heard people say it's a bull market or it's a bear market. Here's what that means. A bull market is when stock prices are going up and investors feel positive. A bear market is when stock prices drop 20% or more and investors feel negative about the market.
It's important to know the difference because investing in each market type requires different strategies.
Another important idea to learn about is stop loss. A stop loss is like telling your broker, buy or sell this stock when it hits this price. It helps you from losing too much money on a stock. Let's say you buy a stock. You can set a stop loss at 10% less than what you paid. If the stock price goes down 10%, it automatically sells. This keeps you safe when the market is going up and down a lot. Knowing how to use stop loss is really helpful for investing wisely. Let's talk about the difference between making money on paper and actually making money in the stock market. Paper profits and losses are when your investments go up or down in value, but you haven't sold them yet. It's like seeing the numbers change on a scoreboard, but the game isn't over yet. For example, let's say you buy a stock for $50, and now it's worth $70. That's a $20 paper profit. But you don't actually have that $20 until you sell the stock. Actual profits and losses happen when you sell your investment and either lock in your gains or take a loss. So going back to our example, if you sell that stock at $70, your $20 paper profit becomes a real profit. It's important to remember that paper profits can change quickly because the market goes up and down. But once you sell, your profit or loss is final. Understanding this difference helps you make smarter choices about buying and selling your investments. Now let's talk about what shares of stock are. When you buy a share of stock, you're buying a small piece of a company. Think of it like owning a slice of a really big pie. Companies sell shares to get money, and in return, you get a part of what the company owns and earns. The more shares you own, the bigger your piece of the pie. Shares are bought and sold on stock exchanges, and their prices go up and down depending on how many people want to buy or sell them, how well the company is doing, and how the economy is doing overall. Owning shares can also get you dividends, which are like bonuses the company gives to its shareholders. For example, if you own stock in a company that's doing great and its stock price goes up, your shares become worth more. But if the company isn't doing well, the stock price might go down, and your shares will be worth less. Understanding stocks is really important for understanding how the stock market works and how you can maybe grow your money by investing. Now let's look at the differences between mutual funds and ETFs, which are short for exchange-traded funds. Both are popular ways to invest where money from many people is pooled to buy a mix of different assets. But they work a little differently. Mutual funds are actively managed by professional fund managers who try to beat the market's performance. Investors buy shares directly from the fund at the end of the trading day at a price called the net asset value, or NAV. Mutual funds often have higher fees because of this active management and might require you to invest a certain amount of money to get started. On the other hand, ETFs are usually passively managed and try to match the performance of a specific index, like the S&P 500. ETFs are traded on stock exchanges just like regular stocks, so investors can buy and sell shares throughout the trading day at market prices. They typically have lower fees than mutual funds and give you more flexibility when trading. To sum it up, if you're looking for someone to actively manage your investments and you don't mind higher fees, mutual funds might be the way to go. But if you'd rather have lower costs and the ability to trade throughout the day, ETFs could be a better fit. Understanding these differences can help you make smarter decisions and make sure your investments match your financial goals. Now let's talk about another important term you'll hear a lot in the stock market: the PE ratio, or price-to-earnings ratio. The PE ratio helps investors understand the relationship between a stock's price and how much money the company makes. To calculate it, you divide the current stock price by the company's earnings per share, EPS. Basically, the PE ratio tells you how much people are willing to pay for every dollar of profit the company makes. A high PE ratio might mean the stock is overpriced or that investors believe the company will grow a lot in the future. On the other hand, a low PE ratio could mean the stock is a bargain, or that the company is facing some challenges. Remember, don't just rely on the PE ratio alone. Use it with other information to get a complete picture. It's helpful to compare PE ratios of companies in the same industry to see how they stack up. To sum it up, the PE ratio is a useful tool for understanding a stock's value, but it's just one piece of the puzzle. By learning about the PE ratio, you can make smarter investment choices and find good opportunities in the market. Now let's talk about another important idea in investing: volume. Volume is how many shares of a stock are traded during a specific time, usually a day. It shows how actively a stock is being bought and sold. High trading volume often shows strong investor interest and can mean the stock is easy to buy and sell without changing its price too much. This is called high liquidity. On the other hand, low trading volume might mean less interest and make it harder to buy or sell large amounts without changing the price. Volume can also show how investors feel about the market. For example, a big jump in volume often happens when there's big news or earnings reports. This shows increased investor activity and interest. By looking at volume trends, investors can get a better idea of how strong a stock's price movement is. For example, a price increase with high volume is usually a stronger sign than a similar price increase with low volume. So, understanding volume can give you helpful information about a stock's trading activity and how investors feel. It's a really important part of technical analysis and can help you make smarter decisions about when to buy or sell a stock. Pay attention to volume as you look at the stock market, and you'll be better at understanding what's going on. I hope these terms make you feel a bit more confident about navigating the stock market. Alright, that wraps up today's episode.
Don't forget to subscribe, hit the notification button, and share this video. Also, check the links in the description.
See you next time. Happy investing.
Take care, everyone.
And before you go, grab a copy of Get Rich by Investing by Craig Smith. Craig is the CEO of the CRAIGTRADER companies and a seasoned investor with a finance degree. This book can help any level of investor become better and more professional. The link to get the book is the first link in the description. Thank you for your support.